Welcome to the Maple Money Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. One of the life-changing steps in my personal finances was to switch to index investing. Today, I'm being joined by another fan of ETFs, Kornel Szrejber. Kornel is behind the popular podcast Build Wealth Canada, and you can find him at buildwealthcanada.ca. Before we chat with Kornel, I wanted to point out a 2016 survey from CPA Canada, where 33% of those polled reported being a victim of fraud. Our sponsor, Borrowell, offers free credit reports so you can verify the information against identity theft, what debts are in your name, and how much is owing. Head over to maplemoney.com/Borrowell. That's maplemoney.com/BORROWELL and review your credit report today. Now, let's talk with Kornel. Hi, Kornel. Thanks for being on the Maple Money Show.
No problem, Tom. Great to be here.
So I wanted you on today to talk about how you invest. I know. Originally you were focusing on paying off your mortgage, and you became quite well known for doing that. But now you've kind of gone into the investing. And I know even at the time you were talking about, well, maybe I should have been investing while doing the mortgage and all that. But now that you are where you are, I know you've been focusing a lot on investing. So what kind of items are you investing in?
Yeah. So, I mean, right now, ever since I started, really, I've just do passive investing just through basically broad market ETFs. So that's all I do. My entire investment portfolio is basically in that. We had some rental property actually as well for a while, until very, very recently. Last week, actually, it closed. So, so we actually sold off the rental property, and now all that money is also going towards basically broad market index ETFs as well. So that's going to kind of be in addition to our portfolio. So I'm officially done being a landlord, which is nice. And now I'm all 100% into the kind of the passive investing world, which is wonderful.
Okay, great. So I know I had this problem, but for your story, why did you choose ETFs over mutual funds?
Sure. Yeah. So I researched it a lot because like you said, we kind of, our big thing was we paid off our mortgage really early. I was 28, I believe, when we did it. Like it was, so like, like kind of before our 30s, we did it. And then as soon as we paid that off, we still had the same lifestyle. So now we don't have a mortgage anymore. So now it's okay. I have to now invest, right? Because we were paying off our mortgage. We weren't saving for retirement, which isn't necessarily how I would do things if I was to do it over again, but that's a whole nother story. Yeah, so I mean, I researched a lot, kind of deciding, okay, what's kind of the best way to do it. And I mean, at the end of the day, yeah, I chose just doing ETF investing through just investing in the broad market index. And I did that over mutual funds for a few reasons. I mean, one of really the big one is the fees. I mean, I remember hearing some stats that you can save hundreds of thousands of dollars by doing it basically through ETFs like this, as opposed to kind of the traditional mutual fund approach. And at first I thought that sounds a little too good to be true. That's way too high of a number. That doesn't sound right. So I actually did the math, and I looked at, okay, well, what fees do ETFs charge? What fees do like a typical mutual fund in Canada charge? And I did the math, and I was like, oh my goodness, it actually is hundreds of thousands of dollars. So it was true. So I mean, that's crazy, right? I mean, when I look at kind of what I pay right now in my portfolio versus a typical mutual fund, let's say 2.5% MER, I mean, it's 17 times more expensive than what I pay, right? So 17. So I mean, imagine you can buy some investments and you can pay $1 for it, or you can pay $17 for it, right? I mean, that's a very strong case to kind of I don't know if much more needs to be said about that. I mean, that's a very, very strong kind of a reason for it. And then one could argue and say, well, wait a minute, okay, yeah, it's 17 is more expensive, but maybe it performs 20 times better, right? So maybe you can make that argument, but that's not true either. So S&P actually has a really good site where they actually look at actively managed funds and they compare them to the index to see how many actually, beat it. And I mean, I checked it actually before our interview today, just so I had a most recent stat. And in Canada, basically 81% 0.69% of actively managed funds in Canada underperformed the S&P TSX, so the Canadian index, over the last 5 years. And if you look at the US, it's 84.23% underperformed, right? So it's like you're paying all these fees, they're really dragging down your returns, and at the end of the day, once all is said and done, it's extremely difficult to pick the winners. I mean, it's possible, you could be in that, let's say, 18% or whatever, and you are able to do it. But the longer the time frame gets, the harder it is for these actively managed funds to consistently beat the market, just because those fees are such a giant drag on performance. So, I mean, that was kind of that was a huge reason. The more research I did, the more I saw, okay, this is kind of the way to go, and I feel very comfortable with it, because I'm not I don't consider myself a stock picker. I mean, I have definitely nothing against that. I think it's great people that can do it well, that devote themselves to it. I mean, for sure, if you're that kind of person where you don't mind reading the annual reports, you enjoy that, you like looking at the financial statements, then for sure, pick your own stocks. There's definitely ways you can succeed with that, in my opinion. But for me, the passive approach is great, right? So I can kind of have those investments in there. They take very little time to do, and I can kind of do different things in my life, basically. So and then I guess the other thing too is if you're doing mutual funds, now you have to also pick, well, which mutual fund manager do I like, who's good, and what happens if they leave from the fund that I invested in, right? There's also that whole thing, right, where now you're worrying about, well, which mutual fund manager, and what things change all the time and all that, versus if the passive approach, you don't have to worry about that at all. So that's kind of another big reason for that.
Yeah, that may be 2% extra that you pay for mutual funds. I think a lot of people, they don't see it as much. So it's like, yeah, I pay 2.5%. What's wrong with that? But
exactly.
I like how you framed it as being 17 times more. I never actually did that math to
yeah.
think what's that really look like. But yeah, even the idea of 2% more is like, well, that they have to outperform that, and that's not easy. so odds are, yeah, they're not going to outperform.
Exactly. It's really tough to do. And then it's really hard for you as a retail investor to find those mutual fund managers that are able to do it and are able to do it consistently, which is a whole nother thing as well, right? I mean, it's really tough to do.
Yeah. You mentioned not being a big fan of investing in stocks either. And neither am I. I played around with it a bit before. I used to have a lot of, I still have them, but a lot of, Canadian dividend stocks. So there I was really buying and holding. I was buying large companies, a lot of utilities and financial in Canada, and that seemed okay because I was saving I was saving paying any sort of MER, and I was also doing a Smith maneuver, which is a whole nother show, but
yeah, that's right. But, maybe a show and a half. That's a whole nother. Yeah.
That's a complicated thing that I don't actually recommend to people, but I was doing it, and so I bought a lot of Canadian dividend stocks then. But now I'm basically all ETFs for any new purchases, especially when it comes to things like technology stocks. I hear people like, "Oh, I've got all this Apple stock and I'm doing so great." I was like, "Well, I just can't keep up with that because technology companies come and go." So that's why I'm not interested in it. Any other thoughts about stocks for you?
Yeah, I mean, I think it's great. I mean, if somebody wants to have that kind of be their craft, if that's something that you're very passionate about, I mean, I'm definitely not like, stock picking is horrible, it doesn't work, it never works. I mean, that's not true. I mean, I've seen it succeed. I know people that are able to do it successfully very well. I think, I do a lot of work with 5i Research, where they're basically like an independent research company where they actually analyze individual stocks kind of in an unbiased fashion. So I'm involved, with them. I'm a big, I feel if this is kind of your craft and this is what you want to do, and you enjoy this, right, then you can definitely, be successful at kind of picking the right stocks. But it's not something that you just kind of, the way I look at it is, look, you either go into it or you don't. You don't like dip your foot in and just kind of, okay, I'm just gonna invest in this stock because I like it, like just for some totally subjective reason, right? I mean, look, you're either going to be a passive investor, like what I do, just because I don't enjoy reading financial statements. I don't enjoy, that kind of component. Or if you like that kind of stuff, then go into it, learn everything you can, learn from the best, and kind of, and do it, right? So that's kind of the way that that's sort of my, my view on it, right? Is that it's not like one is better than the other all the time, right? You just have to decide what kind of investor you want to be. And yes, if you do decide to pick stocks and you learn how to do it well, yes, you can beat the market. Yes, you're not paying MERs while I'm paying MERs. Yes, you might get better returns than me, but only if you do it right. You know what I mean? And there's a lot of people that kind of go into it without really that kind of commitment, and they get burned by it quite severely, right? So, and the people that I've talked to that have really committed to it have done well with it. So, so that's kind of my 2 cents on that.
Yeah, I get, because I get totally that if you can pick the 10 best stocks, you're going to be doing great. But otherwise, though, it's hard to beat that diversification you end up with ETFs. Like you're buying into the entire market. You're not just trying to get that hot stock.
Exactly. It's nice. I mean, I like the passive too, because it's nice not to have to worry about it. I mean, at the end of the day, I don't want to be worrying about it when I go to bed. And I feel, just based on my personality, my temperament, I mean, if I was very heavily into, individual stock, and I'm not talking about even, betting on like 2 stocks, right? I'm still talking about having a nice diversified portfolio of stocks. Let's say, like 20, 25 stocks, let's say within Canada, something like that, right? I mean, even if I did that, I would still feel kind of, I don't know. I'll still always be thinking about it, and what has anything changed at any other companies, and I always have to be analyzing and staying up to date about it and all that kind of stuff, right? Whereas with the passive approach, I don't know, it's just a better fit, I find, for my personality, because I know historically it has gone up significantly long term. I know if I hold it and don't panic sell, I know historically it's done consistently well over the long term, and it just it's nice not to have to think about it and worry about it, and just check it every once in a while, and see how much money you've made, basically. So it's great. I mean, it's just a good fit for me personally.
There is one time when I'm kind of anti ETF is and you might be interested in this, no longer being a landlord, is when it comes to REITs. The REIT ETFs I've seen normally have a bit of a higher expense ratio, but at the same time, I can't remember what the exact percentage is right now, but I think it's like 3 or 4 of these REITs actually make up more than the majority of the entire index. so you can actually buy these individual REITs. I've got them in my TFSA, and that's the one time where I still go out of my way to not do ETFs, just because it's just this bad mix of, like, it doesn't take much to actually be that entire index, and
for sure,
and then you save that fee, and it's still not a huge fee. Off the top of my head, it might be like 0.75, 0.6 or something like that. But it's still one of the higher fees when it's really not giving you a lot of breakdown.
For sure. Yeah. And for things like that, like if you're going into specific, sectors, let's say, and if that's the kind of the way that you want to invest, if that's your sort of strategy or style, whatever you want to call it, then I can see how it being better in certain cases, like you said, just buy those stocks directly, because when you get into some of these specialized ETFs, if that's kind of your thing, their MERs, I find, do tend to be higher than just the broad kind of market index. So you're kind of, you're paying more for that. And like you said, especially in Canada in particular, we are so heavily concentrated in certain areas. Like you said, there are certain ETFs where you'll have just a few players making up like 70% of the ETF. I mean, it's great. So it's like, well, why don't I just own those, like, 4 companies or whatever, and then there you go, I just save myself the MER. So I'm totally with you on that one. If that's kind of the the way that you invest, then I can see how it totally can make sense. I think I heard some people doing that with the Aristocrat index as well. For kind of the people that really want the income stocks, where yes, the MER is higher, and it is held, a lot of it is held by a few key players, and so you can just buy those players instead and avoid the MER altogether.
And that's basically what I was doing when I was buying Canadian dividends. I didn't go out of my way, but I certainly remember looking at those lists. Kind of seeing which had the bigger yields on them, kind of thing, and hoping it would continue, of course, too. But so how do you buy ETFs? If someone's ready to do this, where should they go? Where did you go, and how did you sort of get that going?
Yeah, like, you mean like in terms of the mechanics, how I actually buy them, that whole thing?
Yeah, a little bit. If someone's convinced now that this is what they want to do and get out of mutual funds, which I hope they are getting.
Yeah.
What can they do next to do that?
Yeah, if you're still not sure, just think of that 17 times number, and that should that should put things in perspective. Yeah, so I mean, when it comes to me buying like I basically buy the same 4 ETFs every month, so it's very. I mean, it's not a lot of work. It's basically, if you've never bought an ETF, it's basically just like buying the same 4 stocks every month. But the big thing with ETFs, right, is that you're not buying a company. One ETF can have hundreds, even thousands of stocks, within it, right? So that's really all that I do. So I use Questrade. I'm a big fan of them. I don't work for them or anything like that, but I do like them a lot because they do allow you to buy ETFs for free. Essentially, you do pay an ECN fee, which we can talk about, but basically it's pretty much free. I mean, we're talking pennies once kind of all is said and under $1, let's say, once all is said and done. So that's right. Like, you do pay fees when you sell. But I mean, if you're, if you're not retired yet, you're not really going to be selling them either, right? Or if you are, it's going to be very periodically. So you're not, if you're doing more of a buy and hold kind of strategy, which is what I do, then you're pretty much buying them, which is free. And then when you sell them eventually, yes, you'll pay your $5 a trade, $10 a trade, that kind of a thing. But I mean, yeah, those fees aren't very much. The ECN fee, I actually looked it up before the interview. It's 0.00335 per share. So that's how many cents it is. It's less than a penny per share, right? So I mean, if you buy a few $1,000s worth of ETFs, you're gonna, I mean, you'll pay like, I don't know, like 50 cents or something, right? Like it's nothing. So that's the way that I do it.
Yeah, I'm with Questrade as well, and I think when they started making ETFs not have the transaction fees, that's when ETFs really started making sense for me.
Yeah.
In between my time in bad mutual funds, I was with the TDE series because I could make those. I don't remember if I was doing 2 weeks or a month, but I could make that regular contribution, and it wasn't costing me. If back when you had to pay for ETFs, if you were putting money in every 2 weeks or a month, and you weren't making a big purchase, that transaction fee was kind of killing some of the benefit of ETFs. But now that there's roughly no fee, I think that makes it a lot more accessible to people.
Yeah, for sure. And I think one thing really worth mentioning, and I think some people get held up on this, and is that they think, oh well, if I'm going to invest in ETFs, I need thousands and thousands of dollars available, because I don't want to buy an ETF with just, let's say, $1,000, or like I don't want to buy $1,000 with ETFs. I want to wait till I have more, because I'm paying $5, let's say $10 or whatever it is now, per transaction. But that's not, if you go with Questrade, for example, that's not true, right? You're basically buying it pretty much for free, and so you can buy these really, really small amounts, because there's some, I've read like every pretty much guide I could find out there when I was first getting started about how to do this. And that was kind of the common thing is, well, ETFs are great if you have quite a bit of money to invest, because the transaction fees are really going to hurt you. Well, but there are places you can buy ETFs for free, and so you don't have those transaction fees hurting you. And so don't let that hold you back, that you only have $1,000, let's say. In fact, I always I have a ETF investing course that I have, and one of the and people ask me kind of questions like, well, how much do I have enough to invest? Should I wait before I do it? That kind of a thing. And I say, look, even if you have just a little bit of money, go and do it, because you will learn the mechanics of it. You'll become comfortable with it, and so it kind of, because you're able to buy these ETFs for free, it gives you a chance to kind of get your feet wet and get familiar with everything, feel comfortable with, the interface, how to buy. And it makes you a lot less stressful for you, because, you could go and you could buy one ETF for, let's say, $50, right? And it costs you less than a penny to do that, let's say. And you know what? And you just did your first transactions, and now you can do $100, and then before you know what, you're doing like a $5,000 transaction, and you're not breaking a sweat. You feel 100% comfortable with it. So I really like how they do that too, because it lets you kind of ease into it. Because I mean, imagine your first time buying it, and you're like, oh well, I have 100,000 to invest. Yikes! Where do I even start? Right? It can be very intimidating at that point if you've never done it before.
Yeah, and making a mistake would start to really matter.
Exactly.
I know when I first started with Questrade, that screen to pick out your stocks and stuff was a little bit intimidating. A little bit of practice does help, where you've got all these different choices and stuff beyond just buying it. And I do remember it being kind of intimidating at first.
For sure.
Something, yet like you said, if you're trying out with $50, well, there's not really any pressure there. You're basically just testing it out and getting used to it.
Exactly. So I'm a big kind of fan and believer of that. Yeah, start small, get comfortable with it, and then you're set.
And there, I should point out too, there's certainly other places other than Questrade that offer free ETFs. Some of them have different catches though. I can link them all in the show notes, but like I know some will only offer it on a certain ETFs.
Yes.
And when you're doing a simple portfolio, that's probably good enough, no problem anyways. But it's something to point out that sometimes you don't get those extra options.
True.
So, but I'll link a few in the show notes because I can't think of them all off on the top of my head right now.
Yeah, and like I remember I looked into it, and I remember virtual brokers was one that comes to mind. I remember they had the free ETF buying as well. At this point, because I was basically at the end of the day, I was debating between Questrade and virtual brokers, and I remember the virtual brokers. I think at the time they only had it for certain ETFs, and whereas Questrade was much more open to what ETFs you could. And so I just kind of liked how there wasn't that restriction with Questrade. And I think there might have even been some ETFs that I wanted to buy that I couldn't get for free at virtual, but that might have even been the case. So anyways, but yeah, you're right. There are basically virtual brokers and Questrade are the only two that I know of. I know a lot of the banks, they'll do certain promotions and things like, get 100 trades free or whatever, whatever marketing thing you want to do. But that, which is, nice, but then what happens after that, right? So I really, I like the fact with Questrade, it's ongoing. I mean, I've been with them for years now, and they've had it the entire time. I even interviewed the CEO of Questrade, and I asked them, "Hey, look, are you guys going to remove this? Because I really like it." And I'm telling people to go with you guys, but I get nervous because it's such a good thing for us, And he said, yeah, they don't really have any sort of plans to remove it. They might not allow it on some ETFs in the future, maybe, but right now that wasn't really on his radar or anything like that. So things are good on that front. I'm still staying strong with Questrade.
Sounds good. So you mentioned you have 4 ETFs in your portfolio.
Yep.
What are those and why are you using those ones?
Sure. So I have, so this is kind of for the equity portion. Right now so for Canada, I have XIC, which is basically the S&P TSX index. So, kind of the Canadian market, if you will. So I have for that. For US, I use two. I started using one and then I flipped to another, but they're both, I would say, just as good, depending on your personal preference. So I use the VUN and VFV. So VFV is the S&P 500 index, which is the one Warren Buffett says to invest in, and it's done really well. And I mean, you'll hear that one. I mean, it's a good index. Let's just say that. And then the VUN is is basically the total market one. I hope I'm not mixing the two up, but I'm pretty sure my memory's working correctly here. So and so that one, it's more total market. So you're including some smaller companies as well, as opposed to the 500-ish companies that you get in the S&P 500. And so kind of the whole logic there was that. So I started doing the total market one, which was VUN. And then because historically there's some data that suggests that one should theoretically outperform the S&P 500 because it includes more companies includes kind of more smaller companies, which tend to be more volatile, but longer term, they're more likely to grow. And so you might get higher returns with it, right? So that's kind of the whole theory behind it. But in recent time, what's happened is that the S&P 500 has actually been outperforming the total market index, right? So it's kind of, theoretically, this is what should be happening. What's been happening lately is the other one, right? So for a while, I kind of said, okay, let's do some S&P 500, but it's not like I didn't sell VFV. I still held on to all of it. I didn't touch it. I just said, okay, let's actually get some S&P 500 maybe instead. And so basically, either one of those are good. I would feel totally comfortable in either one of them. That's kind of the status there. And then for the international ones, so I have XEC and XEF. XEC is the emerging markets, so I have 10% of my equity portion in that. And then I have XEF, which is more the developed, so like Japan, Europe, that kind of thing. And I have 23.33% of in there. So basically, the international component together, if you add them up, it's a third. and then Canada's a third, and then US is a third. And then recently we kind of became financially independent. So now I'm actually considering, okay, maybe I should actually have some bonds in there because, we've been 100% equities for so long now. And now that we've kind of hit our magic number, if you will, now I'm thinking, okay, maybe, let's maybe add some bonds in there perhaps. So that's kind of something that I'm looking into pretty heavily now.
It sounds like you're exactly where I am. I don't have bonds either. And it's not that I wouldn't recommend it. Like I just turned 41. People should have bonds at that age. I think I am a little more willing to take a bit of risk, and truly not just thinking I can.
Yeah.
So I've done it. I haven't had bonds, but I've been very purposeful about that. But to most people, yes, I would recommend
for sure
maybe doing that. Sort of that classic couch potato of 25% bonds, 25% international, 25% Canadian, and 25% US. And it's a nice blend that would cover a lot of people. I like the way you've gone where you've got the emerging markets in there as well. It's certainly a different portfolio. Like people can kind of decide how they want that to look. Like in my case, I'm doing very similar to you. It's
awesome.
Basically a third into each of those buckets kind of thing.
Cool. That's good to know. Yeah. Yeah. And I mean, for anyone listening, I mean, so Tom's and I portfolio would be perceived as highly aggressive because we are 100% equities. But I mean, I don't know, I feel very comfortable with it. Tom seems as well. But it's not for everyone, right? So make sure you kind of do your, learn about this some more, and definitely typically you should have a lot more bonds than Tom and I do. But I think you and I are a bit of a different breed as well.
Yeah, we're money nerds. We're
yeah, exactly. So yeah.
Okay, so we got to get going.
Sure.
Can you tell me where everybody can find you, what you've been up to?
Sure. Yeah. So I have a podcast. It's been a top ranking podcast in Canada for personal finance and investing for the past over 3 years now, actually. It's called Build Wealth Canada. So if you go to buildwealthcanada.ca, you can go there, you can sign up to be informed when new episodes come out. There's all kinds of different guides. There is if you sign up you'll get information on kind of the top tools that I use for personal finance and investing. But then I have a ETF investing course as well, which is buildwealthcanada.ca/invest. So definitely, come check it out. Check out the podcast as well. And you can catch me there.
Awesome. Thanks for being on the show, Kornel.
Okay. Thanks for having me, Tom. It was great.
Thanks again to Kornel for joining me. You can find show notes at maplemoney.com/Kornel Szrejber. That's KORNELSZREJBER. Or if that's too hard to spell, just head over to maplemoney.com/show where you can find his episode. Are you a new listener and like what you've heard? Head over to maplemoney.com/iTunes where you can subscribe so you don't miss any episodes and leave a review to let me know what you think.